Subbu, you joined Quantum in 1996 when the Sensex was at 4,000 and mutual funds were a niche product. You're still there. Tell us more.
Yeah, well, you jogged my memory. I joined Quantum in June 1996, and the first week of June, as you know, in Mumbai, is a very humid time. And the first day, my walk from the station to the office was pretty warm and humid. My interview itself was held in May when the weather was very hot. But the office was very elegant. It was an office which was located between Churchgate Station and the ocean. It was small, but as I said, it was elegant. It was actually housed in a doctor's clinic, and we would have patients walking just outside the office. And there was one room which was a bit far from where I sat, and that was where the future analysts would be housed. Later, we actually refurnished the place and we brought in some changes. But what really stuck with me was the glass all around the office, and everything was very transparent. I could see where Ajit would sit, I could see where others would sit. Similarly, others could look at me. And the one thing which struck me at that time was this place is so transparent. There are no hidden cabins. And it was a sort of promise to me. That office seemed to promise me that it will be very transparent. And over the period of years when I saw Ajit work and communicate, the transparency was one thing which held on all through the years. So yes, looking back, the index was around 4,000. The foreigners were still testing Indian waters, and mutual funds were niche, but research was going on at that time.
Subbu, the last time I was with you in your office, I saw that little Ganesh idol on your desk. And I think that has an interesting story behind it. Can you tell us a little more, please?
Sure. So when I joined Ajit and Quantum in 1996, and as I entered the room where I was supposed to sit, two things stuck with me the way it appealed to me. One was the small Ganesh wooden idol at the desk where I was sitting. It had a desktop, and behind me was actually a frame which had Mahatma Gandhi on that frame. And both these were, I would say, my favorite idols over the period of years. And so that desk, that seat gave me a lot of comfort. It made me feel safe. It made me feel warm and being welcomed. And I'm sure the Mahatma Gandhi frame would be there somewhere else in the office. Probably we haven't yet opened and transferred it to the new office, but I still have the Ganesha on my table. And the first thing I usually do when I come to the office is to offer a little prayer before I start my work.
All right, moving on. You told me about this framework that Ajit gave you early on. 4 reasons to buy, 4 reasons not to buy on one page. That almost sounds too simple. Why does it work?
It works because of its simplicity. So when I joined Ajit, we were recommending to a client in the UK, and I had access to a lot of research from global broking houses. So there were large broking houses which would send me tons of research, and I could sit and read the whole day. And when I tried to write a research report for my client, I tried to imitate that, but I miserably failed. It didn't come out naturally to me. So Ajit, when he saw it, he realized that I was struggling to communicate, and he gave me a very simple tool. He said, Subbu, this is the company you are analyzing. Tell me 4 reasons why you think we should buy, and tell me 4 reasons why you think we should not buy. And that struck me for its elegance, for its simplicity, and I used that in all my research reports later on to communicate why I like the stock. And frankly, if I cannot tell you the 4 risks why I don't want to buy a stock, then I shouldn't really be doing analysis of the company. Similarly, if I cannot tell someone the 4 reasons why I should own a stock, then I can't really recommend it to a client. So that was the beauty. It was not very elaborate. It was very simple, and it made my life much easier, because then I could write a lot more research reports over the next few months.
Subbu, take me back to October 2008. I think there was a big event at that point of time. A client called. He was rattled. He asked, should I exit?
Yeah, it was a big event because it was a global event. The large bank in the US, Lehman Brothers, went bust. And after that global financial crisis, as we call it, started, I was actually on a small holiday down south when looking at the volatility, the client called and he asked me, should I exit? And because we had a very strong process of onboarding, when I mean a very strong process, whenever we take a new client, a retail client, we do an analysis of their goals and what they actually plan to achieve with the portfolio they have asked us to manage. And in this case, when we relooked at the long-term goals, when we relooked at his risk appetite, there was no reason for us to panic, even though the markets were volatile. And my clear message to him was, no, hold on. This may actually give us better opportunities to reshuffle with the portfolio. And this, of course, was case with all the other clients, although they didn't call me, but we could use that volatility as a big opportunity to reshuffle. We exited some not so good managements and we were able to buy into some very good managements because the valuations had become very attractive. So here the process became very, very important, right? The process was when the client asked me that question, I immediately knew that I had to check what was his initial goal, see his risk appetite, and then stick with the process. That is that if we are still on track to achieve the long-term goals, we don't reshuffle the portfolio just for the heck of it, but actually make it into a better quality portfolio. And that is what we did in 2008.
You modeled 150 companies in your first few years. Balance sheets, 5 years back, 5 years forward. What does that kind of work actually teach you that you can't learn any other way?
Yeah, so as I said earlier, Ajit taught me to write a research report in a very simple manner. The other exercise he had asked me to do was to actually build financial models on close to around 150 companies from different sectors. And in those days, it was physical balance sheets. So my desk was full of balance sheets. There were hardly any distractions, no mobile phones. And I was very comfortable just holding the balance sheet and punching the numbers and making projections. And that is what I did day in and day out. And we were able to complete the 150 odd companies very soon. What it taught me was, while reading the balance sheet, to really observe what the management say. It made me think why in certain cases the margins tend to improve, why in certain cases the margins actually do not improve. Similarly, I could clearly notice the companies which were efficient in capital allocation, why the return on equity or return on capital employed was better than other companies. So I would say it was a great learning experience on my own. At that time, we didn't have many analysts. And reading balance sheets and punching numbers is, I think, one of the best ways for you to understand different companies, different managements. And you combine that with what you write, the 4 reasons to buy or 4 reasons not to buy, it becomes a complete research tool to understand and why you think certain companies are better than the other companies. These were things which you come to learn as you model, as you type out, as you look at the future projections. And I would say that building that 150 odd companies was one of the best learning experiences I had since I joined Quantum.
2020 was different from 2008. Airlines, hotels, entire sectors went to zero revenue overnight. What did you think about that?
Yeah, so it was a scary moment because it's the first time, it was not the first time. I did encounter a virus-like situation in 2003 when SARS happened, and the Asian markets shook up. But the economy was not closed. In 2020, it was different. You actually shut down the economy. And that means there were a lot of companies which had zero revenues. So it became a question of which is the company which will survive and which is the company which may die out, right? And as you indicated, if you look at the companies which were into the business of, say, catering to tourism or travel, and all of them shut down, and those businesses were really shaky. On the other hand, there were a lot of businesses we saw which had great balance sheets, zero debt, lot of cash, and it looked like even if COVID were to sustain over the next year or two, they would still be existing and probably come out stronger. So as I keep sharing it with my clients, we could underwrite survival at that time, although we couldn't really tell what would be the catalyst which would make these companies thrive after COVID ends. So that was difficult to pinpoint. But clearly, the companies which would survive, we were able to identify by the way the managements managed their cost and by the way the balance sheets were structured for these companies.
So, something you said to me has stuck with me. You said your recurring error over 30 years has been selling too early after all this time and all this process.
Yeah, that's true. That probably comes with what do you call being ingrained with a value philosophy, where generally we tend to buy early in the cycle, in the sense let's say as a share price declines, we think there is value and we may start buying it, and it's quite possible that the decline may continue for longer, and even after I buy, there may be a sharp reduction in the share price. Similarly, on the upside, we tend to sell a little early. This is a characteristic of a typical value investor. Now, having a process to identify, having a process to evaluate a company or put a valuation metrics is very important. But you could also see a situation like this where we miss out on a lot of upside because we sold a little early. The better side of this process is you also avoid some serious companies, see problems, or companies with serious problems, right? What we call landmines. So this process helps you on both ways. On one hand, you may sell out a little early, but on the other hand, the process will also help you avoid investing in quite a few companies. Now, in the case where you mentioned, I can recall a jewelry company which we sold very early, and that compounded stupendously over the next many years. Similarly was the case with another consumer staple company. It was actually a food company which again we sold a bit early because as a value manager we couldn't justify holding it at high multiples. And both these were compounders even after we sold. I realized I don't want to change my process. I may tweak it a little, but the process tells me that this is what I should, at this price I should buy, at this price I should sell. So I'm at complete peace with that trade. Even if I miss a few stocks, I said it's okay, I'm comfortable with this process.
Tell me how this process has helped in the other way.
The same process, while it made me sell out on some good quality stocks, there are many times where I have seen that my model actually tells me that the stock, there is still upside, but the upside is not very attractive. And it's better to exit and reduce the weight. And numerous examples I have in my mind, from utilities to consumer discretionary, where after we sold, we saw the numbers actually turning out to be not so good and the share prices declining very, very rapidly. So the process is like a double-edged sword. On one hand, you may sell out on good quality companies a bit early, but at the same time, you may also sell companies where you realize that the fundamentals are going to become weaker in future.
All right. Any parting words for all of our listeners?
It's the same message which I heard from Ajit, that Ajit used to quote Dr. Manmohan Singh, that investment is an act of faith, right? So what you do it very carefully. You do your work. There may be mistakes along the way, but you take care of your clients. The clients will eventually take care of what you intended to do.
Thank you.
Thank you.